Are you investing or trading crypto while living in Canada? Then here's one thing you need to know upfront. Your crypto is taxed, and the CRA is watching more closely than ever. In this ultimate 2025 guide, we're going to break down exactly how crypto taxes work in Canada, how to stay compliant, and how to legally reduce your tax bill with a little help from KoinX. Let's start with the basics. In Canada, crypto isn't considered currency. It's treated as a commodity. And that changes everything when it comes to tax. There are two main ways your crypto activity can get taxed: capital gains tax and income tax. So, what triggers capital gains tax? Anytime you sell, gift, trade, or even spend your crypto, you're setting off a capital gains event. But here's the silver lining. Only 50% of your capital gain is actually taxable. Let's say Liam buys Bitcoin for $5,000 and later sells it for $6,000. That's a $1,000 gain, but only $500 gets added to his taxable income. Now, the actual tax you pay depends on your total income, thanks to Canada's progressive tax system. For 2025, here's a quick overview. 15% on the first $55,867, 20.5% up to $111,733, 26% up to $173,205, 29% up to $246,752, and 33% above that. The key thing to remember is you don't pay one flat rate on everything. You move up the brackets as your income increases. Now, let's talk about income tax. If you're earning crypto, whether it's from freelance gigs, staking rewards, mining, or even NFT royalties, that's considered income. And 100% of that amount is taxable. So if Sean earns $200 worth of Ethereum through staking, that entire amount is taxed based on his total annual income. Simple. But here's where it gets serious. If the CRA decides your crypto activity looks like a business, say you're mining at scale or trading actively, they'll tax your profits as business income. That means no capital gains discount. Everything you earn is taxed as regular income. And if you accept crypto as a form of payment in your business, it's treated exactly like getting paid in Canadian dollars. You must report the fair market value of the crypto in Canadian dollars at the time of each transaction. Plus, if you're holding crypto as inventory, CRA expects you to value it at year end using the lower of cost or market value. Now, let's talk about something most people mess up: calculating your cost basis. Canada uses the adjusted cost basis method. That means you average the cost every time you buy more of a specific coin. So if Tori buys Bitcoin 3 times at 30,000, 40,000, and 50,000, her average cost basis is 40,000. When she sells, her gain or loss is based on that average, not her most recent purchase. Miss this step and your tax report could be way off. Now you might be wondering, can the CRA actually track all of this? Yes, and absolutely. Canadian exchanges already report large transactions. And by 2026, all crypto asset service providers, also known as CASPs, will be legally required to report fiat to crypto and crypto to crypto transactions, along with personal data like your name, address, and date of birth. Plus, the blockchain is public, and CRA is using advanced tools to link wallet addresses to real people. Let's pause here for a second, because this is where most people get blindsided. You might think that if you use decentralized wallets or offshore exchanges, you're flying under the radar. Nope, that strategy doesn't work anymore. CRA audit triggers include large unexplained transfers, foreign exchange use, undeclared crypto activity, and mismatched numbers between platforms and your reported income. If audited, they can go back up to 6 years and request everything: your wallet records, exchange logs, trade history, even screenshots. That's why keeping records is non-negotiable. You need to hold on to your crypto transaction history for at least 6 years. That includes dates and Canadian dollar values for each transaction, the type and amount of crypto moved, wallet addresses involved, counterparties, and receipts or CSVs from your exchanges. Alright, let's clear up a common question. What crypto activities are tax-free in Canada? Holding crypto long-term, transferring between your own wallets, buying crypto with Canadian dollars, purchasing NFTs with fiat, and borrowing crypto, all of that is non-taxable. But taxable events include trading one crypto for another, using crypto to pay for stuff, and even blockchain gas fees. Yes, paying those with crypto counts as a disposal. Now let's talk strategy. Here's how to reduce your tax bill legally. Use capital losses to offset capital gains. Include transaction fees in your cost basis. Deduct hardware, electricity, and other business expenses if you're mining or operating a crypto business. Invest in crypto ETFs using a tax-free savings account to grow your holdings tax-free. And don't forget, you can use spousal tax credits to split and balance income. The bottom line, crypto isn't a loophole in Canada anymore. It's fully regulated and the CRA is stepping up enforcement. That's why you need a tool like KoinX. It automatically pulls in your exchange, wallet, and DeFi data, applies Canada-specific tax rules, calculates your adjusted cost basis, and generates CRA-compliant reports. Fast and without the headaches. So if you're serious about protecting your gains and staying compliant, visit koinx.com today and let it handle your crypto taxes the smart way. Your wallet and your accountant will thank you. And if you found this guide helpful, make sure to like the video, subscribe to the channel, and hit the bell icon for more no-nonsense crypto tax breakdowns.